So happy Tuesday, everyone. Again, apologies for the delay and technical difficulties. So today we're going to be talking about commercial properties, mistakes to avoid. Kaylee's the expert when it comes to that, so she'll give us some pointers in terms of things to avoid, whether it's poor planning, high maintenance, hidden fees to be aware of. But before I turn it over, I do want to kind of give you a general synopsis of self-direction. And then, of course, if you have questions, we'll allocate some time at the end to get those answered for you. So my name is Reneika Lightbourne. I'm a business development specialist here at Advanta. I've been with Advanta as an employee since 2019, but I'm also an Advanta client prior to joining. So self-direction is something that I actively do. If you have questions or you want to talk more through your scenario, don't hesitate to give me a call or send me an email or visit advantaira.com. So just a little quick disclaimer before we get started. At Advanta, we don't give any tax, legal, or investment advice. We also do provide, we encourage you to confer with your professional team, whether it's your CPA, financial advisor, or attorney. So quick takeaways, if self-direction is a new concept for you, I just want you to know any IRA or former employer plan qualifies to be self-directed. You choose the investment that works best for you. So today we're focusing on real estate related investments, but you get to decide what is it that you want to invest in. And then, of course, knowing that all of the income that's generated from that investment flows back into the retirement account. If there's any expenses associated with the investment, it's paid out of the retirement account. So just a little bit about Advanta and who we are. We've been in business for 20 years as the leading self-directed IRA administrator. We work with investment provider. We work with individual clients looking to use qualified retirement accounts, whether it's an IRA or a former employer plan to invest in alternative assets. Our headquarters is located in Largo, Florida, which is Tampa Bay area. Advanta also has an office in Atlanta, which is where I'm based. But we do work with clients nationwide as we hold a little over $2 billion under administration. And then, of course, for Advanta, we separate ourselves by providing you a concierge-style service where you will have a dedicated account manager, someone who's going to be with you for the life of your account with us. And then, of course, bringing you different educational content, which includes expert speakers like Kaylee. Our webinars are recorded, so this will be uploaded on a YouTube channel within 24 to 48 hours. And then, of course, you can also access my colleague Alex Perney actually hosts a podcast, so you can certainly tune into that as well, or check out our events page for any upcoming future events that we may have. So exactly what is a self-directed IRA? Very simply, it just means that you as the account owner have complete control over your retirement funds, you have complete control over the investment decision, and you get to really diversify your account outside of the traditional stocks and bonds. We have clients that use IRA funds to invest in real estate, but in addition to, you can also invest in notes and mortgages, precious metals, oil and gas. The list goes on and on in terms of what's on the table for you. So why do people choose to self-direct? It's many different reasons, but I'll just really quickly touch on 3 of them. It's a new source of capital, meaning you don't have to take out a personal loan or tap into your bank, your rainy day fund. You can certainly just move those funds over from your retirement account, like an IRA or old 401k, to make that next investment. And then, of course, the volatility, the ups and downs in the stock market. We know with our clients, they like to self-direct and invest in real estate because it's a tangible asset. It's always going to retain value. Someone's always going to need a place to live. And then, of course, the tax benefits, having those rents, those profits, those dividends flow back into your retirement account, tax-free or tax-deferred, depending on the type of IRA that you have. And in terms of the different types of accounts that can be self-directed, for individuals, it's the accounts that you're already familiar with, like a traditional IRA, meaning you get the tax break up front, and then, of course, once you take it out at retirement of 59.5 or later, you pay those taxes at that time. Whereas with a Roth IRA, you elect to pay the taxes up front. As long as you maintain that account for 5 years and you're at the age of 59.5, you can elect to take those funds out tax-free. And then, of course, for if you are a business owner or you're an entrepreneur or have a side business, you can certainly look to self-direct a SEP, simple or solo 401k. A lot of real estate investors typically like the individual 401k just because you have greater flexibility with that. So if you want to know more, again, feel free to reach out to me on that. Some smaller or lesser accounts that can be self-directed are ESA accounts and, of course, HSAs to cover medical-related expenses. With an HSA, you do have to have a high deductible plan, so double check with your plan provider on that. And then, of course, any former employer plan, whether it's an old 401k or 403b or TSP type plan that can be self-directed. For 2023, you can make annual contributions for in a traditional Roth IRA. It's if you're under the age of 50, you can put in $6,500. If you're over the age of 50, you can put in a little bit more, $1,000, an additional $1,000. For solo 401ks, again, you have higher contribution limits where you get to contribute as an employee, but also get to match up to 25% as an employer. And then for ESAs, you can put in $2,000 per year per child. With an HSA plan, again, it depends on having a high deductible plan, but if you're an individual, you can put in $3,850. For a family plan, you can put in $7,750. And then also, if you're over the age of 55 in an HSA scenario, you can put in an additional $1,000. So the process for us to get started is pretty straightforward. When you're ready to proceed, feel free to reach out to myself or one of my colleagues, or you can go to advantaira.com. But first and foremost, you would fill out the paperwork to open up your account. You can do it electronically. You can do it via DocuSign. Step 2 is funding your account. So you can make an annual cash contribution. You can do a transfer from an existing IRA or do a direct rollover from an old employer plan. There's no tax liabilities for you to do that. And then finally, once your account is open and funded, step 3 is make your investment. Is it, investing in a multifamily project or, doing a fix and flip property in your area? And with that, I'll go ahead and turn it over to Kaylee. So let me just make you the presenter.
So I'm Kaylee McMahon, and at the end of this, I'll also give you a website link to go look at. Well, here, I'll just do it now, because usually the beginning of these, I'll actually do it at the end. The beginning of these, usually we introduce ourselves. So really, I'm Kaylee McMahon, the founder of Apartment Queen Investments, the #1 female-focused apartment fund and multifamily syndication company on the market, and we're looking to change the face of multifamily. And what we do when we're doing that is by giving women leadership opportunities in the executive positions that they hold in our company. We're also giving more opportunities for investment for women at a lower entry basis. So when I got started, when I first invested with my IRA, I started at 21 years old and wouldn't have been able to do that if I didn't have a passive investment I was able to get into at $10,000. I would have had to wait until much longer down the road in life to be able to have the 50 grand that's normally required to invest. So we changed that to where there's a lower barrier to entry. And then also when it comes to investments, we give a higher preferred return to the men and those that want to invest with us that bring in a lady, sister, niece, wife, girlfriend, cousin, daughter. There's a lot of that, a lot of dads, that they'll either give them equity in their investment and or they'll give them portal access. They have their own login to look at all of our investments. So we really care about changing the face of multifamily. Why this is, I won't cover the whole issue that we see in the market today, but really what it breaks down to is about 7% of executives in multifamily real estate are women. So that just perpetuates the wage gap more, and we want to fix that. So we focus on bringing in more women. So we're going to cover a deal that we did in Phoenix, Arizona that we actually sold at the end of last year. I will come back and show you how this ended up financially shaking out, because that's what everybody really cares about. Okay, great, you had these problems, but what happened? And this will just show you how real estate tends to be very forgiving. So what we wanted to initially do on this project was we wanted to redo the resident mix. So we have people that are not paying, we have people that are paying under market, we have people that are slow paying. Basically people that can't afford to live at this property are living in the property. So there's bad debt coming in. We normally come in there, do a facelift, turn the units, and we have a schedule for this. And then we were purchasing the property initially in 2019 at $70,000 a door. All the properties post renovation in the area were selling for about $150,000 a door. So we knew going in, if we just did some basic make ready renovations, adding a backsplash, changing the cabinet paint, I mean, just basic stuff that we do, we'd be able to add value very quickly and double what we actually purchased the property at. So every property that we renovate and do a value add renovation to looks like this. We always want to, like I mentioned, re-tenant the property and improve operations. And how we're doing that on this property and every other one is by going into it and actually changing to a property management company who is specialized in multifamily. So this is a 236 unit property. And actually, believe it or not, it was mom and pop ran. So they lived in the property. It used to be a hotel, turned into multifamily years ago. So we changed to Chamberlain, and what they did was they full-time managed over 10,000 units in Arizona, Texas, and New Mexico, and we implemented a stronger screening process in improving the tenant profile. And what we were looking to do as a holistic view of the property's renovation was changing it from a C-class asset to a B-class asset. And so this is typical when we add amenities and change the exterior. That's what we do first while we're re-tenanting the property, is that we'll go in and we'll add changes to the leasing office. So amenities like an internet cafe, some computers, things like that. We'll change the clubhouse, make it nicer. We'll change the leasing office, make it more attractive, put up better signage. Gym facility and equipment is typical. We also pretty much always will add in a barbecue and pool fixtures, furnitures and fixtures, FF&E. And then also this property needed a new chiller and new boilers, which is very expensive. But that was a capital improvement that was scheduled at the time or the age of this property. We also improved the usage of energy on these properties. And so we get better loan terms. So we'll get a Fannie Freddie Green loan. And what that means is we get longer terms, better interest rates, better terms, lower down payment. I mean, just everything is better overall. And what we do is we will actually put in LED lighting, which helps with security. We'll also put in low flow toilets. So we're reducing the amount of water that we're using on the property. And then also, if you're not familiar with rubs or rubbing back, if the property is paying for these bills, we'll bill it back to the residents. And then the portion we're still responsible for will greatly decrease because of us doing all of these changes to it. So I will also change aerators on shower heads and in tubs as well, and also kitchen sinks. So we'll pretty much do all of this normally to every property, change again tenants, amenities, and then change the curb appeal because we've now changed the signage as well. And so everyone goes, oh, well, things are changing. And then as we hold the property, as people move, because we have now changed things and then increased rent, people leave. So that creates vacancy. Then we get in there and continue our interior renovation. I'll show you in a minute what we had planned for the interiors, but then essentially overall, we have an exit strategy. And this is pretty typical. They're going to lengthen out a little bit because we realized instead of stressing so much to do a quick flip and kill us as operators, you can't scale that way, that we can do something that has some value left, but isn't hustle, 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 sell. Moreover, it's creating more value over time, and then we can refinance several times and create the same amount of value. You know, as an investor, I would prefer to have something that's less stressful, less risky, and then over time be able to basically make more money because we're holding it long term and making capital gains. So on this project, it was one of our last short-term holds. It was a 2 to 3 year exit we planned, which is our main focus. However, we did a Freddie Mac loan with a 10-year term. So if we wanted to, we could keep the loan in good standing for 10 years if we wanted to. And we also had a 5-year term, we had a 5-year prepayment penalty on this loan. I believe it was a yield maintenance that was a step down. So point is that the big penalty payment, prepayment penalty wouldn't be an issue until after year 5. So 5 years would be best case. So this is an image of what we had put together with a design team out there that was related to Chamberlain. They brought the design team. The property that was in its original condition, you can see over here on the left. I wish I could pivot that image for you and show you, but yeah, nothing going on with the pool. No one ever used it. There's no places for kids to play. There's no dog park. There's nothing there. And in addition to that, you can't see it, but if I flip the image to the entrance that's on Indian School Road, you'd be able to see that the property is also not secure. It's wide open. So we needed to change not only the security, but the curb appeal, and then obviously put in our own little touch with branding to the property. So in the middle here, you can see what a fully renovated unit looks like. And I think it looks pretty nice, but in reality, when you went to the property and looked at a classic unit, which you'll see in a minute, it really doesn't take that much effort to create this model or this type of fully turned unit. And so I'll share with you what that looks like in a sec. But we wanted to incorporate the color yellow that was already in the property. And then this over here on the right is the front entrance of the property. So we added in more yellow to the property, some sitting spaces outside. So instead of it just being the front door, there were actually like bars on the doors and windows and things like that. So we removed all of that and then made the front entryway there's more visualization with these windows because of obviously removing those bars, but we wanted there to be more transparency so that the view looking out and into the property seemed more welcoming and inviting, and the yellow helps with that too. So this bottom image here, this rendering, was our front office that we renovated everything to. Before, there were just like 2 couches in there, and honestly, the walls are brick. So what it was just thick coats of paint over the brick. And I mean, I don't know about you, but that felt like a jail. So we didn't like that. We wanted to change the curb appeal and then also the appeal of the amenities. So again, CapEx, if you ever hear that word, that means capital expenditure budget. So on these projects, this project, we're going to be spending 1.35 million. And I'm not going to go through every single doorknob, piece of hardware and bath accessory package that we're going to put in each unit. But really what that breaks down to is about $5,000 per unit that we're planning to spend on the interior rehab of the property. And then we also have exterior rehab for a total of $533,250. So this was, again, our initial renovation scoping and plan and pricing. So if you can see here on the left-hand side, that is our actual non-turned units. And 100% of these units when we bought the property were classic, which is a key feature for us. We always make sure that the property has 70 to 100% classic units. And then also we want to make sure all of those floor plans are 10 to 15% below market rents. That is our like magic formula to be able to get 2x on your money in 5 years or less. Can't explain the math on that one, but it's worked 10 times. So, so we're going to stick with it. But point is you can see again the initial unit actual and then the upgraded unit once we're going to put in our renovations. And if you can zoom in and see this, essentially what we went into the property looking at was that we were looking at $750 for our studio units as a pro forma. So this was our year one increase that we're planning. And then our comps, our entry, when we bought the property, it was $664 per studio unit that they were renting at. Our pro forma said that we were going to get $750 in the first year, doing a couple of basic upgrades, not even this much work. We're just going to change doorknobs, paint, a couple of things to test. And then the comps for the market were at that time, they were about $840 average. So $1.90 a square foot. So we were far below market, even when it came to what we were planning on increasing them to, which you always want to do. You want to be competitive with the market. For our one bedroom, same situation. We were coming in with the property being at $793 per one bedroom unit, which is $1.38 a square foot. We were looking to increase to $870, and the market would bear $950 per unit. So we could get from $138 a square foot to up to $154 a square foot. So that was our plan. Again, going in like we normally do, changing the tenants, changing the amenities and the curb appeal and the name and the branding of the property. And then when people start to leave as it increases in price, then this is what we would be increasing our rent comps or rents to based on rent comps. So this was our plan going into this property. And then this happened. Then we had an issue. And so I like to call this presentation show Saturday, because we got a call on a Saturday letting us know that, hey, your property has lit on fire. And, you know, I wish I could hear the reactions out there in the audience as I'm showing this, because this is a picture that I took personally when I flew out to the property. Again, being in Phoenix, you know, we have our boots on the ground that was there, but nothing can change how it feels to really see how massive the destruction was from this fire. So this happened on a weekend. And so what do we do next? We obviously look at all of the damage. I wish I could give you an aerial of the property here, but essentially what I'm trying to show you here is that the property is in 3 phases. So this right side right here, this is phase 3. They were all built at the same time. But then if you look on the left-hand picture here, the portion of the property that contains the front office, the entryway, and 1/3 of the units is facing the street here. And then on the left-hand side of this picture, if it existed and I had a panorama, there would be a 3rd portion over here. So essentially we're like, okay, the damage only affected 1/3 of the property. That's good news. Now let's dig in and see, you know, what the actual issues are and how they can be solved. So of course we have to take action immediately. And this takes the right action with the right timing from our team, and then also our other professionals that we bring on board. As an operator, your biggest roles or job in anything when it relates to these deals or properties, these large scale properties, is to, number one, deal with taxation. So federal, local, and state tax. That's the biggest way to make money. The second biggest way is, like I mentioned earlier, all of the green programs that we put in place, so energy conservation. And then the third thing that is humongous and doesn't always apply to every deal is when it comes to hiring outside professionals that can really really make us a lot of money when it comes to making sure that we're getting the coverage that we deserve, the representation that we deserve. So when we took action, we got involved. Of course, our property management was there, and they put up power poles to make sure that we didn't have vagrants coming into the property, living in these units. That way they're lit up at night. Obviously, you saw the caution tape, so we made sure that everything was taped up and no one was going to that side of the property. And then again, we had to figure out what was actually wrong, right? So 23 units out of the 24 on this side that we looked at had been damaged due to the fire or flooding. Didn't mention yet, but the fire also burnt through the water lines that were above the roof that caused the flooding. So not only did we have a fire, but we also affected plumbing. Then the plumbing flooded the units below. When that happened, the flooding eventually, as it sat there, started causing some issues with mold. So then we had multiple different types of remediation that had to be done, and we couldn't really touch it, obviously, until this exam was done. The exam is always twofold. So property manager gets in there, removes people, makes sure that they're safe, that nobody passed away. If that does happen, then we have a protocol for that too. But essentially what we're doing is trying to figure out where did it originate from, what caused the fire. So we have to also have the police involved doing an investigation. So that also takes time. So once we had the residents moved out of those units who were not affected, some had, the fire units above them, beside them, but their unit wasn't affected. They still can't live there. So we got lucky in this situation where our job typically is to move them to the other phases of the property where we have other units available for them, or to move them off site to a place like a extended stay hotel, and then we have to pay for where they live, or help pay for it, because it's usually going to be more expensive than the rent. So not the whole rent, but that we pay for the difference. But we got lucky in this situation. We reached out to Red Cross, and they were actually on site helping us provide assistance to residents needing temporary housing. So they also helped to relocate those residents that were on that side of the property. So that saved us a whole lot of money, which was just a really great idea that one of our partners had in this situation. So as we figured out the damage, figured out the cause, which by the way, in this situation ended up being arson. So that means that somebody tried to cause this fire to damage our property. So then there's also, again, with that investigation, trying to figure out, fingerprinting, who did it, get that person arrested. But at the end of the day, we're the ones that are suffering because we don't have any income, in that side of the property. So, what do you do? So we have the process where we, again, figured out what was wrong, maintained. So it's just like any kind of emergency protocol. So you secure the property, you figure out what happened, you get facts and data from the police. Then we call our insurance after we had two things happening. So we called two public adjusters that we trust. We ended up going with one that was out of Dallas. They're called Continental Adjusters, and I've actually had them help me on another deal where I had a giant elevator failure, which was going to literally kill that deal. And then they're engineers, so they're very creative when it comes to tying in other systems. Oh, the halogen lights are related to this. Okay, so is the power surge that ended up happening that ended up affecting this pump system in the basement. I mean, they try to tie everything in to an event that happens, a catastrophe. So we ended up choosing one public adjuster. Then from them, we ended up having our own engineer through them come out and get a scope of exactly what it would take to rebuild what was damaged. And then also brought in our own contractors to basically say, here would be the entire cost of being able to repair the property. Plus, again, our insurance has income loss coverage, and you always want that whenever you have any property that produces cash flow, because that's the insurance literally for your cash flow. And that cash flow is what makes investors money on these deals. So it's important to protect it. So we ended up choosing Continental Adjusters for this property. And how did we shake out when it came to finally dealing with the city and at the same time to be able to get approval of our plans, because it's also working in tandem. But because we were represented initially, our insurance wanted their own adjuster, their own, so internal adjuster, their own engineer, to come and look at our property. And because we were proactive and we already had our own public adjuster, our own engineer, our own project management company, and come and get a scope of what we needed to have replaced, we already had the data that we needed to show our insurance company, hey, here's what it's going to cost. So they originally wanted to give us an $800,000 settlement for renovations, and they were not going to actually pay for business interruption, so income coverage, like I mentioned earlier. So that coverage they weren't going to cover, and then also we needed to show them our plans, which again, this is a great opportunity, y'all. When stuff happens like this, it's an opportunity to re-look at things and iterate and change. So we had studios, we had 2 bedrooms that we could turn into studios that were affected by the fire. And because we could essentially get more money from the claim for doing that, then also get more money later on from the rents, because then you're splitting the units, you have more residents, and we're in this market able to get more money for the studios per square foot than we were for the 2 bedrooms. So that was part of our plans that we actually had to argue with the city and then with our insurance. So what's the net? We ended up claiming 1.66 million total in business interruption coverage and also coverage for our renovations that we were needing. So that's quite a big increase from our 800,000 that our insurance originally proposed. And that's 100% because we went with a public adjuster who represented us. And again, because we got the data first when it came to what it's going to cost to repair the property and cover us for all of our losses. So how it normally works, if you're ever hiring a public adjuster like this, is 10% will go to, in this case, it was Continental, to your public adjuster for their fee for representing us, and then also making sure that they are netting us much more money than we are going to get. So our net amount that we received was 1.5 million, which of course, highly worth it, right? You still see that 800,000 that we originally were proposed and then to 1.5. However, I'll tell you, if this does happen to you and you're in the driver's seat, something that I've learned that you can do. So I have a general contracting license, and you can, depending on your state and where you live, I'm just talking about Texas here because that's where I'm used to doing my thing. I've learned that you can actually, as a asset manager operator, use your general contracting license to get all of those bids together and then basically be the project manager over all these bids. And so you can charge a fee for your general contracting services, which could be the same amount as the fee that the public adjuster will need to represent you. So then if you're able to bump up your total claim payout 10%, then we would have kept, in this case, 1.66 million and gotten a little bit more and covered their fee by charging our GC fee, and then being able to net 100% of what that claim totaled, what that payout was. So just FYI, learn a couple things. So also, like I mentioned before, with challenges comes reward. So what we ended up doing with our plan, like I mentioned, to split those units, was we made them a little bit nicer, and we did this by testing. So I showed you guys what it looked like when we first bought the property, our first year pro forma plan for renovations. And then when you look at what we ended up doing for some tester units, we call these platinum. We end up putting some quartz countertops in there. And then if you can tell from where you're sitting, the marble that's here in the bathroom is just a marble look type tile, which is very nice. We improved the doors, again, kept with our vinyl plank flooring that we normally do, and then also tested out a couple of extra amenities. So if you remember before, there was nothing on the property that was a dog park, nothing on the property. I don't have all the pictures from the afters of this, but you can just see here that we put in a dog park for amenities on this side of the property. Plus we put in Amazon lockers. We also put in carports. We started doing things where we could charge more money for just about everything. We also put in cabanas that had those cool drapes on them, so it was like resort style. Again, I don't have a picture of that, but we ended up just doing all these extra things to the property. And this property was in a really great location in basically Glendale, if you know where Phoenix is and you're familiar with the market. So this was a great area. And then we also ended up using some of the funds to improve our Wi-Fi cafe. So net, like I mentioned the prices before that we were going to be charging year one, after testing out this platinum unit, what we were ending up with in our pocket for a studio was $793, and we were only projecting to get $664. We were projecting to get $960 for the 1x1s or the 1 bedrooms, and we ended up getting over $1,000 for the 1 bedrooms, again, with this platinum level upgrade. So with this upgrade, we were able to greatly reduce the projected income for the next buyer. And again, if you can prove out a different level of renovation and say if 20% of your units are, I'm going to make up a letter, are renovation level B, and then you come in and do like a platinum unit like this, and this is renovation level A, and you do that to about 20% of the units total or so, and then you're able to show that next buyer, which we wanted to sell this and had an exit plan in our business, plan. If you can show them that, then essentially, typically, and especially in this market in Phoenix, then that buyer was going to buy on pro forma numbers or buy on their estimate of being able to themselves continue completing these types of renovations and getting these types of rent bumps. There are a lot of assumptions in there. However, Phoenix is an interesting market where it's a boom and bust market. And so for sure, again, we bought this in 19. We were able to have this incident happen and then make something good happen because of it. And people were still, when we sold this at the time, buying it just crazy prices. So selling it on pro forma was something that we were able to do. Okay, dokie. All right, so what I want to show you is how it ended up. I'm going to come back to this in a second. So this is a slideshow on the case study in general of what happened once we finished the renovations. And I'm sorry, I should actually improve these photos, but I hope you can see that we did what we said we were going to do, and those renderings that we did show you earlier actually became reality. So this is a picture of the front office. Again, there was 2 couches in there before, that's it. The front entrance has changed. We have the internet cafe in there, the gym. I don't have pictures of those, but you can maybe see those cabanas that I mentioned here from this kind of aerial-ish photo here around the pool. There's some kid toys that are there around the pool for amenities. The stairs there that were affected were also replaced. And then on the other phase of the property where we had the fire, if you go to the right side, left side here, if I were to flip the camera, you could see that dog park I showed you earlier. So really, at the end of the day, this was a pretty fortuitous thing that happened. We ended up walking away with a 3.59x equity multiple. That is crazy, y'all. So I'll show you what that means in a second with a closing statement. And I'm glad that I can show you all of this because in Texas, it's a non-disclosure state. So I actually wouldn't be able to show you the closing statement, but I can here because this was Phoenix and Arizona doesn't care. So what we did was we increased the property's value $20 million and we went full cycle in 38 months. Now, when you're looking at a potential partner or a sponsor to lead your deals, this is kind of what you're going to want to ask them for is case studies for their full cycle deals. So this is just one of them. And I just wanted to show how a disaster can be very forgiving. And sometimes it's really just about patience and finding the opportunities in the diamond in the rough. So the property, like I mentioned, was 236 units. Our timeline, again, was we purchased it in the end of 2019 in August. Then we sold it in 38 months in October 2022. The purchase price that we bought it at was $16.7 million. Ended up selling it at $37 million. So obviously you can see the variance in purchase price versus sale price. And then our rent and the other income is crazy. The rent, so GPR is gross potential rent. That's something you really want to look at because you want to look at your underwriting and you want to look at the projection of your team in their financials of what they think that you're going to go into the property at, which is your actual rent, right? You can see that on your T12. Then your GPR is your gross potential rent that you are at when you enter is what I'm showing you here. So we are at what we could be collecting was 2.1 million. And then our exit gross potential rent was 3.2 million. So what that means is a variety of things, that we increased rent, increased occupancy, that we added other income to those rents as well. And our variance point is that it was 152% increase in gross potential rent. When we're underwriting a deal, running a financial analysis, what we're typically looking at is for our entry GPR, which is related to your entry cap rate, related to your entry purchase price, they're all related, to go, okay, worst case, if we bought it at this price and we had this income coming in, let's assume over the next 3 to 5 years, whatever our business plan timeline is, that all we can do is keep it steady. That's really how we underwrite these deals. And so with that being the case, then if anything else happens that is good, like this, or there are other things that could happen with a big industry moving to your market, there's all kinds of unpredictable things, then basically we would be able to increase the rent, but we never want to count on that. We always have appreciation of the property, so that's always kind of built in, so we know we'll sell higher than we buy. But as far as this GPR here, this is just a crazy variance. We just, yeah, it usually doesn't look like this. It's like entry GPR is 2.1, exit's like 2.5, you know? So other income, this is nuts. Like I mentioned, we came in there with the Amazon lockers. We came in there with the rentable cabanas, the parking spaces that are covered. We ended up doing, a Wi-Fi program. There were a lot of extra added income items that we were able to input into the property because of this disaster that happened. So our entry other income was 90,000 and our exit other income was 562,000. So kind of crazy, that increase there, a variance of 624%. But, you know, I just wanted to kind of show you how sometimes disaster equals opportunity. So overall, our challenges on this deal started going in, and it started in the middle. It kept going in the middle, and then we ended up exiting. You have people that live in the property. You have workforce housing tenants. You know, this is not like the best area in the world. This is not Scottsdale, you know, in Phoenix. You know, this is Phoenix. So we had crime coming into the property, and so obviously our job was to come in there, like I mentioned, with the LED lights, also blocking off entrances. So we had one way in, one way out, keeping all kind of street traffic out of the property, improving the gate system, giving the scan codes or scan tags to the residents to come in and keeping it for only them. So first this started with a huge raise. So this was the biggest raise to date that we've ever done, $10 million. And we got lucky that we had at the end of the day, because we were doing this with friends and family. So that means mom, dad, brother, sister, anyone out there that I've met. Like I went to Texas A&M, all my alumnus friends, anyone that I've ever talked to or met, for example, can normally do our deals. But if they're investing such small amounts and we have a timeline for closing, it becomes really, really hard to raise money like of this size. And this was our first time doing it. So in this situation, we ended up having a Japanese group come in, and because they really just wanted the depreciation, they were able to put a couple million in. So that really was very helpful. And then now moving forward in our projects, we've been more open to arrangements like this, where maybe we have like a private money lender who has a large IRA and they can actually lend it without UBIT and UDFI tax, and they can lend it into the project for a larger amount. So it helps us to raise on time, and also helps them to save tax. So we've done some other things to be able to make this large of a raise not as much of a challenge, but it was on this deal. And then again, I mentioned the crime. And so we did those adjustments to our security, which really got rid of that crime issue. We again had the massive fire, the public adjuster, the settlement. A big issue, like I kind of alluded to earlier, was passing city code. We've done deals in West Texas, East Texas, Dallas, Fort Worth, Houston, where I'm at now, in Phoenix. I would say that parts of Fort Worth and Phoenix have been the hardest when it came to passing city code and regulations. So we're in the middle of rebuilding. And even though we have, I don't want to get into the stories, but they just made it very hard. Let's just say it like that. So when you're doing a value add renovation, they're not as picky when it comes to the structure of the property. So anyway, that also slowed us down quite a bit in trying to even get to these exit numbers at all. Also, COVID hit while we had the asset and this was happening. So, and we had a Freddie Mac government-backed loan. So they required us to pause our evictions. So we're going, are you serious? Like, we've got people that are claiming that they live in the, anyway, I won't even get into it, but we got stuck with a whole bunch of people that weren't paying as we're still trying to get rid of the residents that are in these units and being able to fix the property up and then bring in new residents. Normally, like in Texas, we'd say, okay, you know, we're not paying, no pay, no stay, like you go. But anyway, we had to deal with this for 6 months. And so what we decided to do, we also had that loss of rental income, and you have people staying and not paying. This seems so stressful, right? We're very dedicated sponsors and figured out a way. So there's always a way. So what we did was we had to swap a property management company where they were used to dealing with distress. We moved from Chamberlain to Asset Living, and we had a property manager who had dealt with big disasters like this, because it takes a very creative manager. Number one, it's stressful. Number two, it's not easy to lease these units. You have to, show people a certain side of the property first. You have to get like a wait list, and you have to get fear of missing out going. You have to run ads differently. You have to really sell the vision of what we're going to be recreating in the property, those plans I showed you of the new amenities. And so it just takes someone who is a really good salesperson, very dedicated, and is kind of used to some stress to be able to even handle leasing this thing back up. And then also these collections were an issue, right? So what we ended up doing was swapping the property management to one that could handle this level of distress. And then also we helped residents one by one to apply for stimulus money and federal assistance. So what we did was we had them, because we also with COVID regulations couldn't have a bunch of people come to the office at once. So we'd have them come like 2 at a time, 6 feet apart, and sit with them and do this 1 at a time. And so that's also in the front end, while we were waiting on insurance to pay, how we were able to cover those people who, no pay and did stay. So that helped us there. And then it also helped us with those that were in the side of the property where they had moved to another unit. And again, we had Red Cross helping us. We just had to do everything we could to figure out how to make up for the income now, and then also get a payout from insurance. Sad part, not a huge issue, I guess, but this property was full of kids. And so one thing that was cool about this property was in our residence center, we did a lot of pizza parties. We did a lot of Halloween and things that had to do with the kids. After school tutoring was a big thing that they liked. They'd come home from school and go right in there. But we had to cancel all of those community events, all of them, for over a year in tutoring due to COVID-19. So that was really hard on our community, also keeping everybody together, because that was one thing we really did have going well for us here because of those community amenities. People did talk to each other, they knew each other, and that's always important to keep people paying and staying at the property. So we ended up pivoting to online. So our tutoring lady that actually, she was a teacher in the complex, she swapped it to Zoom and to the computers. So again, what did help us with that fire was getting that Wi-Fi program implemented into the property. So it ended up helping us to be able to have the whole property use that, and we had much better connectivity in the property, so we were able to do more of that tutoring, remotely. So again, these are the challenges on this property that we made through all of them. And it really took for a partnership with management, communication with the operations. I'll tell you, 80% of the success of a deal has to do with your management company, the communication between you and your management company and the sponsor team, and what our plans are to get through these scary things. And you can only knock one down at a time. So being able to walk everyone through, here's our KPIs for this issue, here's our milestone per week on this issue, and having rewards set up and having a tracker set up to where everyone is on the team participating the same. So it takes a lot of bottleneck solving and working together as a team, but we did it. So here's, like I mentioned, something I couldn't show you in Texas. It's a non-disclosure state, so I would have been able to do this presentation on a deal here. However, I would have had to leave out the name, not put full pictures of like where it's located, and give you just the numbers. Or I could do the opposite, give you the name, all of the numbers, but not the purchase and sale price. So this is the closing statement on this property, flats at 2030 in Phoenix. So what I wanted to show you is, again, this is a little nuts, right? This is not a normal exit. Our average exit is a 2.8 equity multiple. We're always shooting for 2. So what that means is, like, you put 100 grand in, you get 200K back. Like, that's what we're looking to do, is just double your money. But this deal was awesome, hard, but awesome. So you can see here that we sold it for $37 million, like I said before. You can see that we obviously had to pay off our loan. We had closing and brokerage fees that we had to pay out, which obviously are expenses. They get paid first. We negotiated how much cash we were going to give to the seller. And then we can see the LP, or a limited partner's initial cash investment, and cash flow distributions that were made over the hold of the property. So we still made, for example, I'll just tell you, so when you're holding a property and you're fixing on your normal business plan, we usually fix everything value add period for a year. Like, we're fixing everything, we're getting it stabilized, and then we have income that we can depend on. Then we start distributing after year 1. So we were doing that on this property, but we had initially, and I can pull that up later if you'd like, initially we had projected to give our investors, I believe it was a 9% cash on cash return. And because of people not leaving, because of them not paying while they're not leaving, because of losing income on a third of the property, we did not pay out investor distributions for, I think, 8 months when we wanted to. And then once we got to the end of, this was after year 1, no, sorry, it was 6 months. Then we got to month 8. Then we said, okay, let's start distributing something. So these distributions, when we first started making them, instead of giving 9% cash on cash, we were giving like 2 to 3%. And I just really want to be open with you about what that looked like, because it's not all sunshine and roses. But however, we were still cash flowing, right? So that's great. Our main goal is always to make sure that we don't lose the property. And so how you do that is making sure that you can pay your bills. And when disasters like this happen, sometimes it's hard to even have the cash flow to pay your bills. So this is just showing that we did make cash flow distributions during the hold of the project, because typically what you'll see is you'll get money from other income and rents as an investor distributed to us. And then also you'll have the appreciation or the big sale or refinance check, the capital event check that you'll get, which is usually the big one. After return of capital, what I really want to focus down here is on this particular deal. It was an 80-20 split. I got this great question from an investor last night where he said, well, why do you go into an 80-20 split versus I've seen 60-40 splits, things like that. This raise for us at the time was the biggest raise we'd ever done, and we were concerned about the difficulty of being able to do so. So then we just were more generous to our investors, and instead of doing a 70-30 split like we normally do, we did an 80-20. So 80 goes to investors, 20 goes to the team that's operating. And then also it has to do with like the waterfall economics. I'm not going to go into that this presentation, but really, can we still get the investors the money that we wanted to get them and still be able to raise the money in a timely fashion because we have a closing time frame? So we did 80-20 split on this deal, and if you'll go down to the green, I think focus here, the LP or limited partner distribution, again, 80% of the cash after return of capital was $14,735,740.18. So then what that looks like is a total return of investment of 258%. The equity multiple is a 3.59, and this, by the way, 3.59, it's actually 3.63, but 3.59x is after we get paid. So after GP economics are paid. So this is just showing you what was returned to investors. So I think it's important to point that out because some go, well, is this return net of fees, like after your fees? Yes, it is, because we also wanted to show what the investors got purely returned to the LPs or limited partners. AAR is average annualized return. What we're looking to do for our AAR is like 20%. That's pretty good. So typically it's a 5-year exit, 20% a year. That's doubling your investment. Basically, is like the math there. On this deal, you know, we sold this property in under 40 months and had an 81 average annualized return. Internal rate of return on this one was 50%, and our minimum IRR that we're always shooting for is 15%, which in this market today is actually pretty hard to get going into the property, but sometimes things like this happen and, you know, stuff gets weird, we get creative, we make more money. So the distributions, how they worked once we sold the property is that we divvied up what we basically netted. So you can see distribution 1 we gave to investors of $19 million. And so what that consisted of was the total cash plus the remaining capital. And then we had a distribution number 2 after, because sometimes like the dust settles, maybe there's a contractor that the management forgot to pay, a bill that didn't get paid, like just stuff happens as you transition over to that next ownership that might come back to us. So we held back some capital to make sure that was covered. Once everything was covered and you know, we didn't own the property anymore, title transferred, then we had distribution 2 that was just the remaining balance basically after final expenses. So we distributed another $700,000 to investors. So what this project would have looked like if you had gotten in with a $100,000 investment, the sample of your $100,000 investment, we would have given you $342,000 in return for your investment for the first distribution, and then we would have given you almost $13,000 on that second distribution here. So it's pretty good. I can vouch for one investor. If you go look at our site, Neil, who actually did this is the 3rd project he did with us in a row, and he was a retired engineer for Raytheon. And I'm like, dude, we made you rich. Like, and they were using retirement funds too, by the way. So he was doing it tax free. So this was a great deal to say, hey, slam dunk. Even though things can go crazy, you know, we lose management companies, we have to find creative ways to make sure that residents are safe and paying and all these things. Sometimes it works out. So I just wouldn't be so afraid of getting into value add deals because stuff like this does happen. I'm not saying that it happens on every deal, but we have had a fire, I think 3 times in my career so far on 9 deals. So it happens. And I guess if you're looking at the ratio, 33% of the time, some kind of, you know, accident happens. That's why we have insurance coverage. That's why we have general partners that fight for you and that obviously take on the liability of all this too. We work with attorneys. Our LLCs in these deals are the only ones that actually carry liability. As a limited partner, anything like this that happens, they can't come after you. They can't come after your assets. You have a limit to your losses. We don't. So just know that, you pick a good team by looking at their case studies, looking at their exits, and kind of like what they made through. So again, one last time, I won't read every single thing here, but on this deal, what we walked in projecting versus what we actually ended up with, we looked to hold it for 5 years, so 60 months, and we got out in 38 months. We wanted to give you 2x on your money. We ended up doing 3.59 IRR instead of our 15% we normally target. We got 50%. Average annualized return, again, I mentioned 20% is what we shoot for. 81% was what investors got, and we projected getting them 100% over their initial capital invested, and we ended up getting 259%. So that is basically this case study that I wanted to cover, showing you what had happened, then showing you what we did about it, how we ended up making out on the deal, our investors as well. And then really what I wanted to do was show you here. So this presentation is brought to you brought to you by Apartment Queen Investments. And if you're looking to get a hold of us, we have a couple of things to offer you. And how you do that is by figuring out first what you qualify for. So the important thing for us to build a relationship together in the future for a future offering would be to either do a phone call. We have weekly webinars that we host ourselves where investors can ask any questions. That's a good way to get to know us. Or if you might be in the DFW area, setting up an in-person meeting, something like that. But we are actually able to work with investors that are accredited and not accredited. So it's important for you to get qualified as one or the other. And how you can do that is this is our work line that you can text. It's 214-699-8810. So basically, if you're an accredited investor, you can text accredited, that word, to this phone number, and we can give you the correct way to get qualified. So it's a quiz. And then the next step after that is to then go look at what's available. And then on the other side, if you're not accredited, same thing, you would text the word crowdfunding to that same number, 214-699-8810. And you, again, text the word crowdfunding. We also, same thing, you got to get qualified first, then we create a relationship, and then we can show you what is available for you to invest in. Both of these offerings that we do have currently are publicly advertisable. So you'll see those on public web pages, again, that we would send you once you got qualified. And then if you're not sure, like if you're asking yourself, Kaylee, what is an accredited investor? An accredited investor is somebody who, it's changed a little. One, you make $200,000 a year as an individual for 2 years or more. Two, you make $300,000 as a couple for 2 years or more. Three, you have $1 million net worth, not including your primary residence. Or there's a whole bunch of other new definitions that have been added. So if you have a company of any kind, really, an entity, an Indian tribe, an LLC, an S Corp, any entity that holds $5 million in assets, you're also considered accredited. If you work for a real estate fund, real estate investment trust, or something similar, you're considered an employee with substantial knowledge. So you're actually considered accredited. If you have your FINRA license, I'm going to get these numbers wrong, but you can look it up on the SEC's website. It's series 63, 72, and 83. I forget, or 65, 72, 83. I'm probably going to get them wrong, but there's 3 that if you're a broker dealer and you're a financial advisor and you have those 3 licenses, just go to the sec.gov and you can look up what those licenses are. You're considered accredited. So that's another way that there's been more accredited investors created in the United States since 2021. So if you're accredited, that is a way that you can, again, text the word accredited to 214-699-8810. We can get you qualified and start making a relationship. And then same thing with if you're not any of those things, which it's cool. Like, don't get intimidated. Don't feel like you're less than. You're definitely not. You would then just be 88% of the US population, which is everybody else. Totally cool. But we created a crowdfunding offering for you. So if you're not accredited, you would text crowdfunding to 214-699-8810 or 8810. So far, we had brought on 400 plus investors. I've raised, that's a lie, now it's like 5 million myself. And then we got to 1,000 doors actually. And now we're selling off our assets that are outside of these major markets where we can be for sure that we're going to have income to count on. And then obviously we can be for sure of the industries coming in. We can be for sure of the job growth, crime decrease, rental growth, median house value increase, and more that we must have to secure and ensure success of these properties becoming more valuable over time with rents and the actual appreciation value of the property. So those are the two things I want to cover. If you're also looking to do more due diligence on us as a team, I do have a thing. Let me see if I can pull it up. Actually, go to my website if it will load quickly. If you really, which I think every investor really should, do their due diligence on every team that they may partner with, we created a website where essentially you're able to look through our literal resume. You're able to look through, I'll just take you there. So apartmentqueen.com, and then scroll down to here, experience, and then this will take you to a website resume. So this will walk you through our bio, what we're doing and why we care about empowering women and making sure they have access to wealth and being empowered with knowledge. These are some awards that we've won. We were Best Real Estate Philanthropist 22 by American Association of Apartments. You can read through this. We wrote a book. We sign on loans. Have a couple of other awards we've won. We love to do investor education weekly, so webinars such as this. We also have a podcast, and we also focus on raising funds from investors and doing market updates. Like I mentioned, wrote a book. I also project manage and work on construction projects on pretty much all of our deals. And then we work on pooling women together again with our executive team to be able to run these deals. So feel free to, I'm not sure if there's a chat here or if it's through Advanta that we could send this link, or if you just, again, want to go to my website, theapartmentqueen.com, and navigate to this. But the second page here, as you can see, CV, is literally like my actual resume, core competencies, education, where I came from, what I've won, how we partnered as a team. Look through that on your own time. And those case studies, all 5 of them, our exits, are right here embedded into this page. And then also our statement of real estate owned, like what assets do we buy? How much did we buy? How much did we buy them for? How much equity did we put in them? Who is the lender? You can call the lender and you can verify. I'm like so all about transparency. I don't care. So these are the deals that we own in green currently. And then everything that's in red are the ones that we have sold already. And then we have this corpus portfolio that has an offer right now for sale at a 7.8 actually. So a little bit above the actual value of it now for sale. So we'll exit that one soon. But I just wanted investors to really be able to do their due diligence on us. So, you can text those numbers like I mentioned. You can text those numbers like I mentioned, accredited or non-accredited, 214-699-8810 to get qualified and then get in on the next opportunity that we have. And then go to our website, obviously, and look us up, really see who we are. Yeah.
Oh, wonderful. Thank you so much, Kaylee. Great case study. I do have some questions in the question box. I know we're a little over time, but I appreciate you answering a couple questions for me.
Sure.
So one was, first was, is Ms. Kaylee available to answer questions via email? So she did provide her contact information, so you can feel free to reach out to her, but that was one of the questions. Next question is, are the returns the same for accredited versus non-accredited investors?
Yeah, they are. The only difference is really for the preferred return on if you're bringing in a mentee. So I didn't really show that, but if you go to my page, theapartmentqueen.com, there is a button at the top, #1 female focused fund. And if you are investing and you're bringing in a female mentee, so she'll go on your subscription documents, she'll get access to your portal, she'll be able to see how much we invested, all the accidents and things like this that happen, so all the updates, all of the distributions that go out, they'll be able to learn along with you. And so that's one way that we're able to actually bump up the preferred return for those investors that just kind of help us on our mission to create $1 billion invested by, for, and with women. So that's the only way that preferred return changes, is if you're participating in our mission.
Excellent. Next question, and I'll take maybe 2 or 3 more questions. It says, how quickly did you communicate to investors about the damage to the property, and how long did it take you to rebuild?
Okay, so that was like a couple years ago. That was in 19 we bought it, then 2020 happened. The fire happened, I'm just verbally processing. The fire happened a month before the lockdown. So what happened? So basically, if I look back on this one, this one, the communication was, it was Saturday that it happened. So within the next week, investors knew what happened, what we did about it, what the property manager was doing, a couple of photos. So that was the time frame of communication. Was a week as soon as it happened, and then letting them know, hey, this is what we're doing next. So then starts the process of public adjusters, lawyers, investigation, and then that takes a lot of time. So that itself, I think, was 3 months. And then we didn't start renovations until we got a check. So it was really, I would say it was like 3 months of figuring out what was wrong and figuring out who to, where to put the liability, and then how to get paid. That took like 8 months. So almost a year, like 11 months in total, from communication to actually having a check in hand, and then being able to go ahead and start those platinum unit renovations. So quite a long process.
Okay, and then question is, did the total 1.5 million go towards renovating the property?
1.55, yes, it did. Not all of it. So if I remember correctly, our plan was, I don't have the scope in front of me, it's been a minute, but roundabout numbers is what I'll say. So we had planned to do all the interior upgrades, which would be about 800,000. So essentially, somehow the insurance company, that's, I believe, why they originally came up with that number. We're like, yeah, that's great, but we have more to do than just the interiors. We have the structure of the building. We have, anyway, lost incomes. So it was 800,000 for the interiors, and then there was a portion of that that went back to investors after the exterior was done. Let's see, let me do the math. So it's 236 units, it's about 300. So if we had 25 units that were 1.55, I need my calculator, 800,000. So it was 5, 6, 7, so close to 800,000 after we finished the interiors and the exteriors, because we actually got smart. We started taking appliances that worked, moving them around, taking materials that were still good and moving them around. Anyway, so we ended up having, I would have to go get back to you on, the answer is yes. There was money after we actually fixed everything remaining to distribute back to investors. I could get back to you on the exact amount, but it's probably somewhere between 500 and 800,000. So I'd have to go pull that up to know the exact number.
Okay, next question is, the case study shows the period of 2019 to 2022, which real estate, had massive growth. What is the normal return of other properties?
Normally it's a 2x that we're looking to hit. Sometimes we've had a really horrible, like I always like to give like the extreme outlier in the worst direction, because I think if you're comfortable with the worst, then great. Like let's do business, let's do it. So I would say the worst return we've ever gotten was a 1.4x. So essentially what that means is, instead of getting 2x on your money, you did get some growth on your dollars, which far surpasses what it would in the market. Plus you get your K1 losses and your tax benefits as well, depending on the type of entity you use to invest with. And then depending on if you're a real estate investor or if you're not, there's other advantages too. So, so that would be the worst, but normally we target a 2x.
Okay, final question. Are you still investing in Arizona, or are you just simply based in Texas?
No, I believe after studying a lot of what market growth has done in the last 40 years versus where it's going, 1, 2, also listening to other operators here in Dallas-Fort Worth who have scaled to 10,000 units, 30,000 units, and 40,000 units. Those individuals are where we're looking to go. And so it's all about systems and processes and scaling up. So that is where we need to go. And all of their comments have been, you've got to get out of anywhere else but like 6 zip codes and focus there. And so now we have just kind of said no to like everything, unless it's within like 30, 40 minutes of my house in Southside Fort Worth, so that we're boots on the ground and we can be in everything and make sure that everything is being rolled out on time. Our KPIs and standard processes are being met. So it will only happen in DFW moving forward, so that we can scale up pretty big. So that's the last one I'm doing in Phoenix.
Okay, great. I think that covers all of the questions. Again, thank you for sharing the case study. Great information as always. If you have any questions that you want to talk to me about self-direction, definitely feel free to give me a call, send me an email, or visit advantaira.com. Kaylee, before we close out, do you have any parting words?
Yeah, the only thing that I want to communicate with investors, I tend to kind of get in the weeds and talk a lot about like really small details or things that maybe my grandma wouldn't understand, right? And I know that the best way to get wealth to the majority of the population is to be able to communicate it in a not such a technical way. So, you know, if there's anything in this webinar, anything that I've said that you don't understand the terminology, or please do not feel any kind of way about it. Again, you can text that number, even the word webinar, and we have a weekly session where you can ask me anything and I'll go through and explain it. I could give you a book of definitions, anything that you need for support to be able to build your wealth, because what we're looking to do is have a partnership with every human. Like if you're a firefighter, if you're a cop or police officer, excuse me, if you are a teacher, if you are pretty much anyone that has a retirement plan, you can invest in these assets. So I just don't want to be the one to, like, say, discourage you by, you know, being using big words or making this seem like it's untouchable. It's not. Like, this is available for you to make that kind of money and not have to wait until retirement, not have to wait until you have $50,000, $100,000. There's ways to get going today. And with our partnership with Advanta, they're the ones that actually know how, I don't know how to convert that account over to something that is available to be self-directed into real estate. I don't do that part. They help us with that. So it's really important to be able to do that. I mean, get it out of the market, y'all. Things are not going too hot. And I'll tell you also, in these assets, even if the values go down, which, like, you're like, oh, what about 08, 09, 07, 7, 8, 9, values do depress sometimes over time, right? But the property itself, if it's bought right, especially in major markets and in the right area, it's still cash flows. So it really doesn't freaking matter what the value of the property is. You're still getting cash out. And then if we have properties like we've had that are super distressed and they don't have cash flow for a while, the property over time always appreciates. And then again, anyway, so if you have a retirement account, a pension, if you have any kind of teacher retirement savings, there are ways for you to make wealth now and not wait forever. So I'm happy to answer any questions. And then also when it comes to the self-direction, it's not overnight. So you have to start the process today to be able to have access. When we have a deal that pops up, we have like 30 days to raise the capital. So sometimes self-directing your account takes over a month and then you miss out. And what we're trying to do here is reach out to friends and family and those that don't normally have access to this. Banks have access to this. We have life insurance companies that invest with us, large chunk life cos. We have bank promoters and other family offices. They can throw us a couple million. I'd rather do webinars like this and get in front of individual people to make individual people that we know wealthy versus just making the banks and the big boys more money. So please get invested today. And how you can do that is by every person using your retirement account to self-direct into real estate.
Okay, great. One final question that just came in, how to get your weekly webinar information.
Yeah, so if you just text that number, 214-699-8810, the word webinar, then I will just send you the Eventbrite link. And it's also available through my Instagram profile in the link in bio. Go down to Eventbrite events, or you can text me, either way. And I'm happy, I have it saved to my phone. I can just ping it to you. It takes 2 seconds. So any way you'd like more information or to get involved, we've got it for you.
Oh, wonderful. Thank you so much, Kaylee. Happy investing, everyone.
Thank you for your patience.
Thank you.